My name is Tom Kelleher. I'm with Oiko Credit, where I manage our private equity impact team. We have presence in 9 countries, my team, and we invest in about 50 companies globally. And it's my pleasure to have the panelists here, who I'll introduce in just a minute, who all have more than a decade of experience in private equity themselves with the firms that they're currently with. And I wanted to thank the Financial Inclusion Forum of the UK for hosting this event, bringing us together for this conversation. I first started investing in private equity impact back in 2005. So the industry has come a long way. I love to talk about private equity and was thrilled with the invitation. It has become even more relevant today, though, than a few weeks ago with recent developments. I mean, the Financial Times today brought up this subject, has the horror of Russia's invasion of Ukraine thrown a curveball at the impact investment movement? Or is it the coming of age moment for the industry? Defense companies, do they now qualify for impact investments? Is it going to qualify in the ESG screening? What about investments in oil and gas? Should we have been making investments in those sectors so that we'd be in a less precarious situation today? We're going to discuss those issues and more. This is an enthusiastic audience, we can tell from the previous session. So we welcome audience participation. We want to make this a conversation. To get a little bit of a feel for who's in the audience, and this will guide our ability to discuss some subjects. Can you raise your hands if you are investors and looking to invest in the impact space? Thank you. And what about the degree to which you work or invest or are looking to invest outside of Europe? Just get a sense for that. Okay. All right, great. Thank you. And it looks like for the folks who are remote, we've got about 75% of the group are investors and maybe 50 or 60% are investing globally outside of Europe. And this ties with our panelists and where they're focused. I'll let them introduce themselves. I'd like to start out with Orsi Farkas. Please introduce yourself, and then we'll go to the next 2 panelists, please.
Right. Thanks, Tom. And great to be here in person. In my case, for the first time, I think, post-COVID. So I work at Triple Jump, and I had Triple Jump's financial institutions equity team. Triple Jump is a Dutch fund manager, impact-focused fund manager, established 16 years ago. And the industry's changed quite a bit. So I also can reminisce a bit about what has changed in the impact investing world. One of the big changes is that there's such a broad group of people, including not only traditional NGO development finance, but also institutional impact investors. Just to say a few more words about Triple Jump. So I mentioned we're based in the Netherlands, but we invest globally in emerging markets and frontier markets. Initially in microfinance, that's been broadened more into SME finance as well. And the latest fund that we've raised is focused on clean energy in sub-Saharan Africa. We see microfinance as a channel to reach a wide population and have impact. And the new initiatives that we are working on will use that channel in a broader green, for example, affordable housing theme, and to reach in emerging markets ordinary people who are trying to improve their lives and manage their finances. Yeah, just a few words on numbers. So we manage about $1 billion in assets. It's private debt, private equity, and fund-of-fund investments. And we have now a staff of about 100 people based in 6 regional offices. And I'll stop there.
Thank you, Orsi. Great to have you here with us. Our next panelist is from IMP out of Paris, and that is Hugues Vincent Genot. Please introduce yourself. Merci.
So hi everyone. So my name is Hugues, or Hugh, or Hugo, or whatever works. So I've been working with INP, which is a Africa-focused SME fund. since 2011. First in Ghana, then Burkina Faso, Ivory Coast, Uganda, so on. And at INP, we do two things. One is investing directly into SMEs. So we've been doing that for 20 years now. So as minority equity investor into SMEs. And we've made more than 200 investments in 16 countries in Africa. And about 35 exits. And we are now investing our third generation fund and raising the fourth generation fund, which is going to be a Pan-African education-focused fund. And the second thing we do is using that track record to back new funds in Africa that are typically created by what we call first-time teams, so fund managers that create their first fund. And we support them, invest in their funds with fund-of-fund facilities that we also have in order to hopefully grow the sector of SME funds as a whole. And we're also definitely looking for co-investors to invest alongside us in all these great first-time teams.
Very good, thank you. And our third panelist is Nimit Shah with Helios.
Thanks very much. Yeah, so Nimit Shah, I'm a partner at Helios. Helios, we're an Africa-focused private equity fund and actually broader private investment fund, primarily private equity. We also have a private credit strategy. We've been operating for, getting on to 20 years now. I joined the team about 15 years ago now. I grew up in Kenya, and I think that's sort of pretty similar to most of us investing within the Helios platform. And I think for us, it's always been about starting from the ground up. We think it's really interesting to be working in our home markets. We have probably about 15 different African nationalities across Helios. And then for us, it's really about sort of the, creating a virtuous cycle between finding interesting opportunities on the ground in Africa, applying global capital. So we manage about $4 billion of capital, primarily from institutional sources, and then helping those businesses with a series of, basically our own toolkit in terms of operating capability, partnerships we form with people, and then helping those companies grow within their home markets and generate sustainable impact within those markets. And we think that forms a really helpful virtuous cycle, allowing us to raise more capital and invest it on the ground. So that's a model for us, and it's always been about since day one. Although we never, I have to admit, defined it on day one as impacts. It's been about trying to generate really interesting opportunities on the ground and to generate returns from those for ourselves and the broader community. So that's Helios.
Yeah, thank you, Nimit. So when we were working to assemble the panel, there were different ways of kind of categorizing the participants, and I think that it worked out quite nicely because you have Triple Jump and Orsi, where they started out really where I think to a large degree it all began with finance investing and financial inclusion. And then it goes over to Oog and INP, who I think identified a missing middle opportunity with SMEs in East and West Africa. And then with Nimit and Helios, where they are investing in larger companies, significantly larger. I mean, the ticket sizes are 50 to 100 million pounds. But growth capital for larger companies in private equity. So kind of keeping that framework in mind, I think would be valuable for the audience to hear about sort of what drove the strategy initially. Like, why did Triple Jump focus on microfinance and financial inclusion, and Oog more on SMEs? Where did you see what was missing? And then Helios, what did you see back then that is proving to be, say, still interesting?
I mean, first, maybe with a moment of humility that we are not the only ones focusing our microfinance, nor the first ones, but we are one of the larger fund managers in this area. And we started with a focus on microfinance because we believe it's a way to achieve impact at scale. The beautiful thing about microfinance is once you find the right business model that fits in a given country and given country's circumstances, based on that business model, you can really grow and reach a really significant group of people. And we think that that is great. On the investment side, for our investors, it also means that we've been able to grow our assets under management and invest them in a way that we feel is sustainable and can continue in the future.
Over to you.
Yeah, on our side, I think it comes from the impact focus that we have, which is to create formal jobs in Africa, and from the fact that we see that in most countries, developed markets, emerging markets, around half of the jobs tend to be created by only 5% of the fastest growing companies, and these tend to be startups and SMEs. And so trying to identify them and give them all the support they need to grow as fast as they can, I think that's really our mission. And in a context where we know that every decade Africa is sending 125 million people on the job market, but with a fraction of these which actually have a formal job, access a formal job. I think only 16% of the African workforce has a formal job today.
A lot of work to be done. And Nimit.
Well, we saw an opportunity to generate financial returns, actually. And I think the reason we saw that opportunity is because we thought, actually, if you take the global private equity toolkit, it's pretty interesting. And all of us looked at doing it in the West before. And what we thought was much more interesting about the continent in which we operate is that you're able to have a much more significant, really broader impact, right? So if we look at our businesses, you're able to help shape not just the companies, but also the environment in which they operate, which allows us to generate better returns, create more jobs within the businesses, and really transform the value chain of a lot of these businesses. And what that means is obviously more jobs, actually more value added within these businesses. And typically the focus for us is on offering products that are either cheaper or better quality, and that generates returns, and that allows us to generate more sustainable growth within our businesses. And so we saw that opportunity as being much greater than simply buying sort of widget manufacturer X and merging it with widget manufacturer Y in Europe. And it was much more meaningful for us in terms of return as a result.
Thank you. So definitely be keeping questions in mind. I'm going to ask kind of an easy question and then a more challenging question of each panelist, and then invite others to ask questions, okay? So be thinking of them. So here's kind of the slow pitch, to use the baseball analogy. But bring to life, tell us about an investment that you've made that was both impactful and also financially successful. Why don't I start with Hugues, and then Nimit, and then Orsi, which makes sense.
Okay, that's an easy question.
Oh, yeah, okay.
No, because out of 200 companies, there will be at least one success story.
Sure.
No, but so we invested, we set up a fund in Burkina Faso, I think 6-7 years ago, and made an investment via that fund we made a 300K investment in a maize processing company, so which was doing around $1 million in sales, 100K in EBITDA for people who are in finance, and but which was totally informal, totally disorganized. So imagine a warehouse, 40 women with artisanal mills, dust everywhere, and very bad working conditions. So not at all ESG when we invested. And long story short, now it's a business that we're exiting as part of a $10 million fundraise, which happens probably once every 3 or 4 years in Burkina Faso, where it's not a country that's well known for active private equity, and with 3 Pan-African funds that are getting involved, including EcoCredit. And I'm not going to share the IRR, but it's very, very good. But I think what's important for us is that it's a business that created more than 50 jobs, and that's supporting 3,000 maize farmers, and that provided the irrigation to maize farmers in a context of Burkina Faso, where, as you may know, desertification is quick. So that's the kind of investment we like because it takes a lot of work to get in at the beginning. You need to formalize a company, you need to recruit staff, you need to do everything because the entrepreneur is typically a trader who's becoming a manufacturer, so he has a lot to learn as well. So you work a lot, but in the end, you see a company that can attract significant capital for its context and create meaningful, lasting impact. So that's one example.
Thank you. What about you, Nimit? What comes to mind?
Actually, it's sort of similar themes. So about 5 years ago, we invested in a company that was in the food space. So we partnered with a European corporate, a Spanish corporate, and together we identified an opportunity to buy a company that operated in the sort of culinary products or cooking product space in Africa. We thought that was interesting because it's a space that is both, essential for the meal, but also a relatively small part of the, it's all the taste, right, basically. And so this business operated across most of West Africa, but with a very large concentration in Nigeria and Ghana. And so what we thought was really interesting about the opportunity is that the business had lots of scale, but for two countries, especially Nigeria and Ghana, which are probably the largest consumers of tomato paste in the world, it was 100% import business. So everything, from the raw material to the processed goods to the packaging was being brought from outside of the country, typically from China, Italy, and the US, and being sold. And so it's a business that we thought had real potential for transformation. So over that 5-year period, we were able to take that business from a pure export kind of trading hub to a business which had, by the end, we sold the business last year to our partner, about 70% of its product locally manufactured. So, but that was both the processing and the value addition, but also by the end, the farming. So we actually we're proud to be able to do the first farming of tomatoes on an industrial scale for tomato paste in Nigeria, and in several generations, sort of several thousand hectares. And so we're able to go through that entire journey. And we didn't go through that journey just because we love complexity, but because we saw an opportunity to, frankly, to add value across the whole of the chain, create lots of jobs. We created over 1,000 jobs, and more importantly, also create a business that had a much more sustainable product. So your margins expanded. We're able to actually improve prices in the market and generate value for everyone across that channel. And the other effects of that include things like moving from an expat workforce to 100% domestic workforce. And on the financial side, it was pretty successful for us as well. So we're able to weather some pretty significant storms. So the Nigerian naira went from probably about 150 naira to the dollar to about 350 when we exited last year. But we're able to generate through that period an annualized about 21% US dollar annual growth rate because of this value addition we're able to do, basically able to expand margins, grow the product base because you're offering a higher value product. So that was actually one that generated a good return for us, and probably the one I'm most proud of because of the profound impact we're able to have within the business and the broader environment.
It's great. Yeah, win-win-win, and reducing the energy consumption by substituting and bringing that production locally is something we're seeing more and more of. So I like those examples a lot. Orsi, what comes to your mind on this?
So my example would be a microfinance institution in Cambodia that some of you in the audience might know, Tom certainly, because it's an investment that our funds did jointly, called HKL. I will not attempt to pronounce the full name. They started out as a micro-lending program, became a company. We invested in 2008. And 2 years later, they'd received a license to take deposits. Throughout this period, they grew quite a bit. And throughout the time of our investment, went from let's say, a former NGO-based operation to a regulated entity, which is a huge change in the financial sector, as you can imagine. and moved up the regulatory ladder. When we exited, they actually became a bank. And this is all nice on the institutional development side because, and I think what certainly on Triple Jump side we appreciated is that we hope in part, thanks to the work that my colleagues did on the board of directors of this institution, on setting up good governance, on pushing the teams, the excellent management team, to really take these steps in transformation. It's a lot of small things. We had to be patient. It took 8 years, but they did go quite far and become a solid microfinance bank.
And going forward, is that focus on micro lending continuing with the acquisition that took place?
Micro and SME, actually, and we continue to work with them, or my private debt colleagues continue to work with them. So it's not something where we drop things, which is also something nice in the company, that we can keep very long-term relationships.
They remain a client of Triple Jump's debt side. Yeah, okay. Thank you, Orsi. All right, so a little bit more challenging question for each. Oh yeah, please, let's make it, please, go ahead.
Katrina Baker from Ecolab. Just a question for Hugh. Did you measure your dust levels before and after?
My what, sorry?
Dust levels.
The dust levels in the factory?
Yeah. Did you actually measure them? See, so rather than say subjectively, we've done this, did you actually measure that to see what the improvement was?
I don't think we did. I think we did a measurement with the eye, which was quite easy, but quite easy because it went from opaque to clear. No, I think that's typically something, it's an important question, and it shows that sometimes when you make an impact investment, you are very far from ESG standards. You will invest in a company in Burkina Faso where the work safety will be an issue until you actually fix it, and you take 6 months or a year to fix it, to reach at the minimum what's necessary legally, locally, but beyond that, obviously also. So yeah, I think probably now it's measured, but I would have to check.
It's always hard to get the baseline.
Sure.
There's another question we can take now, please.
I had a question in the same sort of line. If you think of impact investing, you think of intentionality, measurability, and I feel a little bit in your stories that, yeah, there are stories of impact, but was this impact intended? Was this the impact that you were after right from the beginning, and how did you measure that? And and this is, I think, of course, it's difficult to measure, and the whole IMM is still very much at the beginning stage. But I think, especially for you here in a panel, I think it would be good to hear a bit more about that, and also to bang the drum more about intentionality and measurability. So if you could actually all three say a little bit about that part of your story, I would think that would be really adding value.
So good segue into intentionality and how you measure that in your respective investments. Please.
I can respond to that. It's a very good point, and again, now looking specifically at the microfinance sector, it's something we as a sector, so all of the large investors together have been working on. There was some discussion earlier in the keynote speech on regulation and maybe self-regulation of an industry, and the microfinance sector has put together, through the Social Performance Task Force, has been working for years to agree on a standard that everybody could use to measure intentionality and actual implementation on the ground. In our case, in the financial sector, specifically client protection, major focus. And I don't think we quite measure how difficult it is to get a big group of people to all agree to apply the exact same numbers, calculate the exact same ratios. And that is what has happened over time in the microfinance sector, and that we are proud of. And sorry, on intentionality, I do have to admit that I don't think we could have foreseen when we invest in HK where they would go. We have, we don't pretend to foresee the future 8 years down the road.
In that sense, I don't know in impact investing how usual it is. I know sometimes it's bounded around theory of change. But if you work on the NGO side, then that is something that you do as a matter of course. But from the impact investing side, I'm still trying to find out like how much of a theory of change is actually made beforehand.
Maybe I can try to answer. I think for this question, I think the theory of change work happens when we design the investment strategy of a new fund. So we will say, which country, which ticket size, which instruments, and why. And like to give an example, when we decided to launch a fund in Burkina Faso that makes investments between 50K and 500K, it's because that's where we saw the biggest market failure, lots of entrepreneurs, no capital for them, and therefore the biggest additionality, and therefore hopefully a good positioning in terms of growth returns and also impact, because no one else is doing it. And so it happened when we designed. And then the everyday work starts, where you proactively go to meet entrepreneurs, receive entrepreneurs, and try to find the best ones. And so it's partly what the impact investments you will do will partly depend from the opportunities you see on the market. So you will not decide to do a maize deal because you think that's the best thing to do. You will decide to do a maize deal because you find a great entrepreneur who happens to do maize, and you decide to back this person.
Yeah, no, look, I think these are the right questions. I think for us and internationality and measurement actually can be related or can be not related, right? So I think for us, it's a few answers I'll give you. I think one is for us, the only reason we're doing what we're doing is because we think actually it's an opportunity to make some meaningful change in what we're doing and generate a return while we do that. And so we pick sectors where similar, I think I definitely support what you're saying, pick sectors where there's a potential to make a difference, right? So financial inclusion is a big word, right? But for example, in that space, we look at businesses within the payment space. We've done 5 deals within the payment space, and they're really transforming the lives of people who don't have, and frankly, may never have access to credit cards and bank accounts. And so we have a few businesses that do that, but we'll have, for example, access to prepaid mobile phone credit. So one of our businesses allows you to make payments using your prepaid balance. For initially, it used to be ringtones and so on, but now it's for your bus journey. And so for us, it's really important to find businesses that have a sort of real tangible use in the market and are transforming people's lives in a way that may be sort of a little bit obvious to people in this in this country. So that's sort of maybe one answer on sort of the and I think the only way people can test that is by really spending time with the individuals and saying, look, why are you doing this, right? As per the prior panel, and is there a real reason behind that? I think in terms of the measurement, we all struggle with that. I think the way we've chosen to address that is we're a B Corp as Helios, and spent some time thinking about sort of the fact that this needs to start at home with us, and we need to be tracking some things of our own, even though it's in a modest way versus some of our companies. And then within our portfolio companies, we've just contracted with EcoVadis, who will do an annual assessment of each of our businesses and track those. And that's important for us, and we'll report that back. But we also have some financing facilities for our business that will where the rate will move up and down depending on how we perform against those. And so we have some carrots and some sticks around that as well. And we'll see where that goes. As you say, it evolves, but it's pretty important for us that it doesn't just become a nice sort of story to tell by the fireside.
And if on that last point, I think that it's to make it clear, because I found it very interesting what Helios is doing, is they're facilitating financing to their portfolio companies so that the portfolio companies can operate more effectively. And there's a link, though, to ESG standards in order to release that funding and to adjust the interest rate even. Yeah. Is that right?
Right, yeah.
Okay, great. Sorry, this gentleman, I saw his hand up first, and I'm not keeping great track, but one of the two of you in the front row, second or third.
All right.
Sure.
Thank you. My name is Kayode. I'm doing a master's in strategy and leadership at London Business School. But I've done private equity in Nigeria for more than 10 years. So I understand the terrain and how difficult it is for a commercial fund manager, private equity fund, to even make good return on investment when you're not even focusing so much on impact. So I guess this question is more for Helios, and other guys can also chime in terms of how do you balance that? Because like I said, I've worked in a couple of funds in Nigeria, and I know when we're not even trying to do impact and we're trying to do commercial returns, it's tough. You mentioned the exchange rate issue that can wipe you off, on day one. So that's first. So do you and then when you're doing your allocation, do you tactically just say, okay, we're allocating so much for impact investment? And also when you're choosing investor, are you also focusing on, because again, investors demand some sort of return, right? And it's difficult to balance that also trying to make impact. I'm just trying to understand, how do you manage that whole, when you're doing emerging market investments? Yeah.
Look, it's a key question. And I think for us, it can't be we're not looking at businesses where you have to make a choice between return and impact and kind of other things. It has to be, we have to pick businesses which check all the boxes actually, right? So it has to be a sustainable return that we're generating, and one that makes sense for us, but also makes sense for the customer, for the stakeholders, for the government. It just has to make sense. And the reason why we think that's important is, frankly, fundamentally, we believe in that, and we want to look back upon that, but also because I think that creates the most sustainable businesses. So we don't have here's the commercial bucket and here's the impact bucket. We think actually that all businesses should be operating in a way that's consistent with those standards, and where over time you kind of ratchet up the level of those standards. So we think that, to this point on intentionality, that has to be the way you generate both, value for yourself and return. So I think that's the right way to do it. Now, obviously, what that means is there's probably some businesses where you could have made a good return, quick buck, or even a sustainable return, which feel to us like they're not operating in that way, which will fall by the wayside. And so you have to work harder to get there. But the beauty, I think, of our markets is if you spend enough time, and we've been through this for 4 cycles now in terms of 4 fund cycles, then you can find those investments. The key, I think, for us is to be really, really focused on very narrow and specific investment themes and to operate within those. So look, it's hard. It's really hard. And Nigeria, like many markets in Africa, is a tough market to operate in. But when you have markets where there is just a fundamental need, then we found that actually, whether we think about a business called InterSwitch, which operates in the payment space. You've probably heard of InterSwitch if you operate in Nigeria, where basically what we did is we able to buy the business from the banks and convert it from just a switch for those banks to a fully fledged payments business, which we then had Visa invest in a couple of years ago. Or you think about a business like Helios Towers, which we founded as a towers business because we saw an opportunity to, for something not to be owned by the telcos, but actually operated elsewhere. There's lots of opportunities to do that, but you got to put in. We think the time and probably the returns will come.
It's a question that if he had the perfect answers, we'd all be taking the notes, the step by step. But it's challenging. But yeah, kudos. I want to transition to a couple questions up here, but while you're doing that, you may, or Orsi may comment on that, but I also want to introduce this subject that's on my mind, which is in terms of sectors that traditionally have not been embraced by impact investors. So oil and gas, and I understand IMP made an investment in the gas business.
Yeah, in Ghana. Yeah.
So could you just tell us a little bit about that and how you deal with this struggle?
Sure. So we made an investment. So INP made an investment, $3 million investment in a company that distributes gas in Ghana, cooking gas, basically to households in peri-urban areas and small towns. And I think it's one of the best ecological investments we ever made. But it's fossil fuel because the context is that in Ghana, in a lot of these markets, small towns and so on, people cook with charcoal, which comes from wood, which comes from the forest. And that in Ghana is within West Africa, it's one of the countries where deforestation is the fastest, in fact. And replacing that charcoal with cooking gas is much more friendly for, let's say, in terms of emissions globally. But more importantly, it's a very important adaptation tool for these markets, because they don't have to deforest as much as they had to before, and they cook in much better conditions. That's also a key issue. And importantly, I think we have to remind ourselves that in Ghana, so I think in Europe, the emissions number of ton per capita of CO2 emissions in Europe is between 5 and 10, basically. In Ghana, it's 0.5. So we can think about climate change mitigation in Europe, in the European context, and so on, and we can invest in green energy in Africa. It's very important, obviously, but the key aspect, at least from where we stand, is to invest in adaptation in Africa, because they will be the continent is one of the ones that will be the most affected, and that's clearly an adaptation play, for example.
Yeah, thank you. And I think Elizabeth touched on that transformation and also dealing with the nuance, and intentionality is clear, but it's not perfect. But perfect,
no, it's still
can be the opposite of good. So yes, please.
I'll be quick. Just one quick comment and then a brief question. Wayne Hennessy Barrett, 4G Capital. We are a digital microlender for SMEs micro and SMEs in Kenya and Uganda. We're a B corporation, and being a mission-driven business makes us a better business, because we prioritize our customers, we prioritize our staff, we prioritize the mission, and consequently, we've grown almost 100% year on year. We've just closed the Series C with Light Rock, which is a fantastic milestone for us. So I'm just here to say from the trenches, as it were, that the system does work, but that alignment between an enterprise that serves its clients and the alignment with the investor is critical. Question for the panel. Are you seeing a merging of so-called developed with frontier markets in terms of exits, acquisitions? Are Western or Northern Hemisphere countries looking to acquire within Africa and other emerging markets as they wish to enter those very important growth markets? Are we seeing emerging market companies starting to list on Western bourses? Thank you.
I'm happy to start. We are seeing it. So obviously we're minority equity investors, so we have to exit. So typically after 5 to 7 years, we exit our investment. And to give you and what we are seeing is that a well-run, medium-sized company, even in the most traditional sector, it doesn't have to be fintech, is attractive, because there's not so many well-run, medium-sized companies in a lot of these frontier markets. And so typically we one recent exit we made was on the Kerry Group, which is the main, it's the global leader in flavors and tastes. We made an exit on Danone. We made an exit on EDF, which is the French multinational in energy. And so we're seeing more and more interest from multinationals, including for taking minority stakes in SMEs and working with the founder for a while, and maybe at the end of the relationship taking over, but basically entering as minority and partnering with founders, which is for us important, because we wouldn't want to go against the wish of the founders. So we are seeing this more and more, but the truth is that at least in our SME space, liquidity is still not as plentiful as it would be in Europe. But we hear the question a lot, you are equity investors. We heard that it's not possible to exit from African SMEs, but our experience is that when the SME performs, you find a buyer. So liquidity in itself is not the issue. You may have less of a bidding war because you don't have as many people. So, maybe less profitable, but liquidity in itself is not an issue.
Thank you for the
Yeah, I would-
question. I think this gentleman in the first row, and then we'll move to you two.
Thank you. Very interesting. I'm Nish Katecha. I'm an entrepreneur and investor and former board member of Financial Inclusion Forum. My question is, have you changed the way that you price political risk as we see the increasing weaponization of sanctions? Thinking Ethiopia, thinking obviously the horrible situation with the invasion of Ukraine.
Great.
What happens if you own one of those companies? How do you?
I think we should direct that one to Orsi. We could.
Yay. Yes. No, and it is an excellent question. Because of the mandates of our fund and what our LPs identify as countries they would like us to invest in, we cannot just avoid entire regions or be very, very politically risk averse. That said, we're not about to run headfirst into a wall. Diversification for us obviously is the number one mitigant. That said, for example, several of our funds have a lot of exposure in Central Asia and the Caucasus. We don't have investments, for example, in Russia, but still indirect impacts will hit us. And what we look at when we look at an investee is the resilience of the business model. Thankfully, microfinance, and we've discovered this through the COVID period as well, a lot of the small businesses, a lot of the agriculture-related businesses will be hit by shocks. So we expect to see shocks, obviously, in Central Asia and countries that are highly reliant on the Russian economy. But we also are confident, because of past crises, that given a bit of time, the underlying micro-entrepreneur sector will adjust, and therefore also the institutions can adjust.
I think maybe I would say actually it's probably developed countries where political risk is underpriced and underprovided for, because in our markets, it's pretty par for the course, right? I think you see ups and downs. You think about leverage in a prudent way. You build these businesses so that there's a really resilient core within the community. And so, yes, they're not immune, and you'll see things like Ethiopia, I think it's a good example where things happen. But I would say actually in general, people tend to be pretty prudent around this stuff. Now, the products around sort of some of these specific risks can be a bit nuanced, but I think in general, it's between leverage and some of the prudence of the business models, it tends to be pretty high on the agenda already, actually.
Thank you for the question. This gentleman 4 rows back, please. And just as a heads up, I think we've just got about 3 or 4 more minutes. So, yes.
Yeah, actually, my name is Dr. Shiva from iBank. Actually, I'm a little bit surprised because if you see the traditional sound only I'm hearing from the start, mostly traditional banks or these companies are very much risk averse. When it comes to anything, even we'll say EDF or Denim or corporate banking, those examples, where is the inclusion? I'm thinking the crypto market or the blockchain market industry, it's a 2 trillion market and it is doing more, even like in Ukraine. You can see that the crypto donations are accepted. Nigeria, Kenya, Ghana, even M-Pesa. So that particular area was not even taken. I don't know.
So just we need the question, please.
Yeah,
and then we can
actually what I'm
later.
asking is the crypto industry or the minority, that industry is doing quite well. Why it was not, kind of discussed? That was my question.
Okay, are any of you investing in any crypto-related businesses? Not yet?
Not yet.
Metaverse is coming, I'm sure. But okay, thank you for bringing it up.
I think it's the only thing I'll say is that if you look at the fundamentals of some of our markets, Nigeria again is a good example. Crypto will play a big part in transforming how those markets operate, and you're starting to see some of that in terms of kind of real life applications. And I think those real life applications will be adopted much quicker in our markets for the obvious reason, right? There's less of an existing base to disrupt. So you will see some of that stuff. So we see that indirectly through many of our sort of payments businesses, but we're not sort of punting on Bitcoin. No.
Yeah, stay tuned. Yes, this gentleman, and then right here, please.
Regarding Triple Jump's microfinance investments, what kind of sectors are you seeing that are exciting you across Asia? And is there the capacity for kind of standardization of microfinance kind of debt in terms of capital markets down the line?
Yeah. So maybe I'll start with the second, if you don't mind, the standardization question. I think that is what has been happening as the industry matured, that there are accepted general standards on the impact side, as I mentioned, also on the way funds are structured and the ways we fundraise, and also the universe of investors that we are talking to. So that's developed quite a bit in the last, I'd say, 5 years, with much more institutional investor interest. As for Asia and where we see opportunities in Asia, the quick and easy one, is India, in the sense that India has a very mature microfinance sector that went through a major crisis, but where the regulator afterwards stepped up in a very significant way and put in place excellent regulations, which have helped the sector to develop. But many investors are in Asia, ourselves included, you guys as well, in India specifically. So we actually need to look at a few other markets that are smaller and less developed, and where we see more growth potential in the long run, but where we basically need to do a lot more legwork to find the good investments, as Nit had mentioned.
Thank you. Yes, please.
Hi, good evening. How do you see the future of real estate in some of these developed countries, whether it's Africa or East Asia? Do you think now that things are progressing and there's a lot of regeneration going in, any particular countries that some businesses, international businesses, should consider investing in real estate? Thanks.
Nimit, has your firm invested in real estate?
We have. So we don't have a real estate investment fund, but we have invested in real estate through our main fund. So we invested in again, as with everything else, we try and be pretty specific. So we invested in an affordable housing business in East Africa called Acorn, and we basically backed an entrepreneur, and we built a JV doing that. And the thesis there was, if you look at student and young professional housing in Nairobi specifically, and then elsewhere, it's really horrible. Right? It's really people having to live in pretty squalid conditions, and so we saw an opportunity to create a very simple offering, but one which has all the basics that young professionals and students would want. Wi-Fi, clean, safe environment, proximity to school, etc. So we backed that business, and it's done really well. It's taken some time to get the model right, and the nuances within the local market continue to be ones that we work on. So we built that business. It's now doing pretty well. It issued a green bond a couple of years ago that was listed on the Nairobi Stock Exchange, and actually on the London Stock Exchange as well, and issued a REIT program as well. So we're able to innovate a fair bit within the technology around sort of building, but also around the technology on financial products. So it's been really interesting for us, but there was a lot of sort of firsts along the way to do that. What we don't have is a sort of real estate development business. We think there's others doing that, but that's a different proposition.
And on that, INP has a number of country funds that you've established with local and angel investors, right? Are you seeing real estate investment activities among those funds or those investors?
So we typically don't do much real estate. We invest a lot in companies that provide building materials or in construction companies. But we don't invest in projects, like a real estate project. What we see is, so I'm not really qualified to answer. However, what we see is that typically investors in these markets compare the performance of our funds against their own real estate investments in these markets. And depending on the cycle, this has an impact on our fundraising capacity, because a lot of these markets have seen very, very strong real estate returns. And now some of them, like Kenya, are going down. But it's very much an asset class that is, I think, still quite artisanal in many ways, and tough to navigate, but with a lot of local investment at play.
Yeah. Mm-hmm. I think the hospitality space, by the way, is another interesting one, which will kind of come and go, but it feels like a pretty interesting time to be looking at that. So that's another one that could be interesting.
Okay, well, maybe the last question to the, yes, please, over, no.
I'm Sophie, I'm Head of Sustainability for Private Capital EQT. So I suppose question to the audience around 39 billion in the private capital segment in terms of assets under management and a large impact-driven fund which launched last year. So I suppose my question to you is lessons for the mainstream, or maybe aspirations for the mainstream in terms of the scaling of impact. What would your hopes be?
Thank you so much for that question, because that's the perfect sort of final comment that each panelist can give. How about Ug, and then Nimet, and then Orsi?
If I understand the question well, it's how do we see the impact sector managing to become more mainstream? Yeah, I think from a very narrow lens of African SME investor, I think what we see more and more, and what we think is the key for the growth of the sector, is to have more local fund managers raising local capital to invest in local companies. And we've seen experiments and done experiments on that have proven very convincing, both in terms of returns and impact. And we think that's really the way forward. And if backing these teams requires certain instruments, a certain risk-taking capacity, but we feel that until the impact investing sector in Africa becomes more African-led and managed, it will scratch the surface. So that's, I think, the big, let's say, the forest behind the tree is how to achieve that.
I can see you might inspire a long talk about ambitions, but we've just got about a minute each because the rest of the group's coming in. So
yeah, that's a good, fair warning. Actually, that's good. Yeah, how long do you have? I think it's I think that actually managers in our markets have done. I would say actually, I'll speak for myself actually rather than the broader market. We've done a bad job in the past of labeling and marketing ourselves as impact in the truest sense. And I think we are impact in the truest sense because you're sort of operating ground up, to your point. And so I think fixing that and being just much more clear about what we're trying to do from an intentionality perspective, which I think is what we're trying to do in the theory of change. But really sort of, for me, I think one thing that's really important is to be able to transmit that in a way that's much more digestible for others. I think on the flip side, I think that global capital, a lot of money has been raised, public equities was kind of talked about earlier, where people have said, look, this is my impact strategy. And I think some of that really rings hollow for me. And so hopefully there's a meeting somewhere where some of that money that's gone to strategies that are a little bit made up can transfer over to what we're doing as we try and explain better what we're trying to do. So I think sort of a meeting of the minds there on what I think is a big opportunity from a global capital perspective, and a big need from a perspective of sort of our sort of play. And Hugo was talking about the liquidity requirements on the ground. So hopefully those can start to meet, and we'll just have more money flowing into impact within emerging markets where it's required, I think.
Here. Orsi.
I think, I hope that the impact investment sector can stay reasonable and modest, which doesn't sound very sexy, but there is always a risk, of course, if there's a lot of money flying around, that we overpromise and cannot deliver. And we really need to be cautious about that. And that I hope that for new investors coming into the sector, they are also willing to listen and be patient, that if the message from a ground up is, yes, we can do it, it might take more time, that message gets through and it doesn't discourage investors, that there is this patience from the investor side and prudence from our side on what we promise.
Good. Okay, I would like to thank all of you as the audience, active participation and listening, and thank you to the panelists for their time and engagement.
Great, thanks so much. Back into the room.